Polaris Renewable Energy, TSX ticker PIF. Q2 2026 numbers are out. And, well, we have a bottom line miss on top of a year-over-year top-line contraction.
Yeah, it's a tough look right out of the gate.
Right. Revenue clocked in at $19.9 million, which is down from $21.6 million a year ago. And EPS, they're showing a net loss of 4 cents a share.
Which is a stark drop.
A really stark drop from the 10-cent profit we saw in Q2 of 2025.
And the adjusted EBITDA.
Adjusted EBITDA is sitting at $13.7 million.
Right, down from $15.4 million last year.
Exactly. So the stock has been digesting these numbers, and for you, the retail investor trying to weigh this name, the mission of this deep dive is to figure out why.
Right, like why did the top and bottom line contract so much?
Yeah, and we need to unpack whether this is a structural decline in their legacy assets or if it's just, a temporary weather-driven hiccup.
A hiccup that's maybe masking a massive long-term growth pivot.
Exactly. So looking at those headline numbers, sliding from net income into a net loss, the immediate instinct is to look for a fundamental breakdown, right?
Sure, yeah. You look for a flaw in the business model, but analyzing a renewable energy producer requires recognizing that the financial outputs are inextricably tied to just raw physical commodity generation.
You can't fake megawatts.
You really can't. If the natural resources don't flow through the turbines, the cash doesn't flow onto the balance sheet.
Makes sense.
So consolidated power generation fell 8% year over year.
Right, dropping from roughly 215,800 megawatt hours down to just 199,130.
Exactly. But here's the thing. Management notes this was actually expected.
Wait, really? Expected?
Yeah. The primary driver was a return to what they call normalized hydrological conditions in Peru and Ecuador.
Oh, right, because last year they had that exceptionally strong water availability.
Exactly. It led to record hydroelectric generation at those run-of-river facilities. It was a high watermark that just, it wasn't sustainable.
Okay, let's unpack this. It's like a retailer getting a massive one-time sales surge from a viral trend on social media.
Yeah, great analogy.
And then the market punishes them the next year when foot traffic just goes back to the normal baseline.
That's exactly it. What's fascinating here is that evaluating these renewable stocks required stripping out those weather anomalies.
Right, so we aren't just looking at the raw financials.
No, because management framing this as a reversion to the mean rather than an operational failure is highly accurate. Higher energy prices in Peru and Panama actually helped offset some of this production loss.
So if you generate fewer megawatt hours, but sell them at a higher rate,
you soften the blow. The facilities performed exactly as engineered given the water they had.
But we can't just blame the rain, right? Or, the lack of it.
No, absolutely not.
We need to look at the ground-level operational hurdles because they impacted margins across some very specific geographies.
Yeah, the grid realities are critical here.
Like the Dominican Republic. Production there continued to be heavily impacted by grid curtailment issues. Curtailment was at 29% for Q2.
Which is high.
It's incredibly high. Management says it's an improvement from Q1 2026, but let's be real.
It's still a huge chunk of power.
Yeah. Here's where it gets really interesting for me. Diversification is great, but a 29% curtailment means almost a third of their potential power is just being thrown away.
Thrown away because the local grid literally cannot absorb it.
Exactly. So as an investor, how do you even model for an infrastructure failure that is entirely outside the company's control?
Well, you have to price it in as the inherent risk of emerging market utilities.
Right.
The Dominican Republic grid just lacks the transmission capacity for peak noontime solar.
So they just have to disconnect.
Pretty much. But this is where their geographical diversification actually proves its value.
How so?
Because you don't evaluate the DR in a vacuum. Look at Panama.
Oh, right. Panama was the lone bright spot this quarter.
Exactly. Higher production driven by better solar resources and improved plant performance.
So Panama picks up the slack.
Right. When Puerto Rican wind dies down, which, they noted was a modest decrease purely due to lower wind resource this quarter, or when the DR forces a curtailment, Panama helps smooth out that localized volatility for the retail investor.
Like a seesaw.
Exactly.
Okay, but what about Nicaragua? Because the geothermal steam units operated as expected. But
the binary unit took a hit.
Right. They suffered due to constraints on brine reinjection capacity.
Yeah.
And lower steam in one of their cycling wells.
Yeah, Nicaragua is a highly technical subsurface engineering issue.
Geothermal isn't weather dependent, though, is it?
No, it's baseload power.
Yeah.
It runs 204/7. But you have to actively manage the underground reservoir. If a cycling well isn't maintaining pressure, you have to throttle back.
So they're fighting geological friction.
Exactly. The reservoir isn't failing, but it's a constraint.
Okay, so with these legacy assets facing natural and, grid-related caps, management's commentary makes it pretty clear they are pivoting.
Pivoting hard.
Yeah, toward a new growth engine, utility-scale battery storage.
BESS. This is the big story.
Right. So on June 5th, 2026, they executed the SO1 agreement with PREPA in Puerto Rico. That's for a 71.4 megawatt battery energy storage system at their Punta Lima wind farm site.
A 20-year term. Right.
Yeah, a 20-year term for fixed performance-based payments. And closing is expected in Q3.
But look at the capex on that.
Right. The Puerto Rico capex is estimated at $70 to $75 million gross.
Which is massive. But crucially, they expect U.S. investment tax credits, the ITCs, to offset 30 to 40% of this.
So that's like a $20 to $25 million benefit.
Exactly. It's a huge boost to the economics of that specific project.
Okay, but then a month later, on July 3rd, they executed a mixed investment agreement, a CIM with CFE down in Mexico.
Oh, the Mexico deal.
Right, for 3 projects. It's 250 megawatts of solar, plus 61.6 megawatts and 192 megawatt hours of battery storage.
And the estimated capex on that one?
A massive $240 million.
Yeah, that is not small change.
No. So what does this all mean? Between Puerto Rico and Mexico, management is looking at roughly $315 million in gross capital expenditures.
Right.
They're essentially adding a massive mortgage to build a new wing on the house right when their quarterly paycheck took a hit.
Yeah, the optics on that are tricky.
Are they overextending? I mean, that's what everyone's wondering.
Well, if we connect this to the bigger picture, you have to look at what they are actually buying with that capex.
Okay.
They are moving from simply generating power to storing it.
Right, BUAS.
Yeah. And that changes the revenue profile from variable, which is, totally weather dependent, to fixed.
Because they're getting paid for grid support service.
Exactly. It's a highly attractive shift for long-term equity valuation.
Right.
Predictability is valuable.
Predictability is valuable, for sure.
Mm-hmm.
But to answer the question about overextension, we have to pivot to the balance sheet.
We do.
Because they need to fund this pipeline while keeping retail investors happy.
And that is a very tight needle to thread.
Yeah. So cash position sits at $98.8 million, which includes $5.6 million in restricted cash.
Okay.
Net cash from operating activities was $15 million for the 6 months ended June 30th.
Just $15 million in ops cash.
Right. And current and long-term debt sits at $216.7 million.
Mm-hmm.
And despite all this capex, management remains focused on the yield. They are maintaining the 15-cent per share quarterly dividend.
Payable August 21st to shareholders of record on August 10th.
Right. But the cautionary statements in the fine print highlight some real risks here.
They definitely do.
Closing these deals is contingent on regulatory approvals, finalizing the engineering and procurement costs, and crucially, finalizing definitive PPAs in Mexico.
This raises an important question for you.
Yeah.
There's a massive tension here between maintaining a cash-draining dividend payout while simultaneously funding a $250 million development pipeline.
It feels like they have to choose one or the other eventually.
Exactly. And they stress that realizing those U.S. ITCs in Puerto Rico isn't just a nice little bonus.
Hub's load-bearing.
It's a critical component of their capital allocation strategy if they don't get that $20 to $25 million benefit.
The math gets really ugly really fast.
Exactly. The legacy assets need to keep churning out cash to service the debt and pay the dividend while the development team scrambles to finalize the BES financing.
Wow. So to briefly summarize the takeaway for you, the retail investor.
Yeah.
Q2 2026 was undeniably a transition quarter.
Yeah, no doubt about it.
Hydrology normalized, which brought revenue and EPS down. But the underlying cash flow remains just steady enough to support the dividend for now.
For now, yes.
While management executes on these major battery storage deals in Mexico and Puerto Rico.
Thinking about all this, it leaves me with a final, rather provocative thought to pull on.
Okay, let's hear it.
It connects the two halves of this whole earnings report.
The legacy assets and the BESS pipeline.
Exactly. So if grid curtailment in places like the Dominican Republic is currently forcing Polaris to throw away 29% of its power.
Yeah, that massive 29% chunk.
Right. Well, battery energy storage isn't just an expansion strategy for new markets like Mexico and Puerto Rico.
Wait.
Could the ultimate endgame be retrofitting their entire legacy portfolio with batteries?
Wow. Just to stop bleeding curtailed power.
Exactly. You put a battery next to the solar park in the DR, you store that noontime energy instead of throwing it away.
And then you sell it back to the grid during the evening peak.
Yes. It fundamentally changes the terminal value of their existing assets.
That is huge. That is definitely something for investors to watch in future quarters as this BS strategy rolls out.
Absolutely. It could be a game changer.
Well, if you want to stay ahead of these kinds of structural shifts and get the real story behind the numbers, make sure to hit the follow button. We're doing daily earnings coverage and more financial deep dives into the reports moving the markets.